Good morning, this is Ken Long from Tortoise Capital with a review of the daily trading plan for June 26, 2013. We got a bull volatile market. We're in the middle of neutral for annual trading range with a score of 59 out of 100 on weekly RSI 14, in the middle of the 10-day trading range at 47 using the 10-day NDX. Yellow bullish with price relative to the 200-day moving average. Slope of the 50 is still red bearish, as weak as it's been in the last 6 months. ADX is strengthening on the bear side at 22.3. ATR percentage at 1.52 is as volatile as it's been in the last 100 days, as you can see down here in the time series. We're still about 2 standard deviations above the 100-day normal. You can see ADX improving with bears in charge. However, the bulls are starting to close the gap a little bit. We came out of oversold conditions, and now we're right at the midpoint on the 10-day NDX. No signals in overreaction or channeling. You can see the risk index, this little bimodal hump after a dip to minus 1.5 standard deviation, starting to reduce volatility here. I still think that makes XIV an interesting anti-volatility shorter term play. Only 2 patterns, one triple screen in Hewlett Packard, 1551W in Cisco, gold, Europe, Euro-Asia blends, silver, IBM, anti-volatility treasuries, blended commodities, and Brazil all coming in at better than 2 to 1 on the auto framer. In the Dow Tactical, quite a few, about half of them are still better than 2 to 1. IBM is of interest here. It's got a good frog quality number at 3.1, number 1 on the max pain range compression, and 5 to 1 on the auto framer reward to risk. Intel and Travelers both testing out well also. Just a couple of dojis, JP Morgan and Merck, nothing fired on the RSI 2. The recovery the last couple days have taken that away. Inside the ETF 30 tactical summary, no patterns whatsoever. A half a dozen dojis, tons still testing out well on the reward to risk ratio. Gold and silver should be of great interest, with the washout here of RSI 2 in the single digits, and both were the big losers, and testing out at 5.6 to 1 and 7.7 to 1 on the auto framer. That should be of great interest in both directions. I mean, that really represents a turning point in the psychology of the metals. In the auto framer itself, again, this is ranked by reward to risk ratio on a mechanical entry with a retest of the 10-day high, and then using this adjusted my risk to determine a reasonable level of mechanical risk, if you will. Most of the time right now it looks like everything is using range risk, which is yesterday's high plus a nickel to buy, yesterday's low minus a nickel for the initial stop, except for blended commodities and coal. So still quite a few to choose from, and now you have all the mechanical trade frame numbers there to use for reference. 2 days of recovery off this swing low here. You see the regression line, plots the price right on the regression line. On the time series compared to its 10-day moving average, the slope of that regression line is finding support here at 2 standard deviations below the 6-month average. This would be a natural place for the market to have support at 158 after a 4 standard deviation move down in terms of slope. It's made a 3 standard deviation retracement here from the swing high about 168. This is price relative to the 200-day moving average. So this is becoming a strong candidate for a swing low, and that's the way I'm going to treat it on the long side. We're still in a bull market. We've had a significant pullback, and now can buy some quality at value prices. And just going through for your reference. You see the 10-day regression line slope has started to roll over. 30 is finding support after a 3 standard deviation move down. The 90, however, still is at the upper end of the normal channel here. And what that just says is that yes, this really has been a bull market and has had a larger than expected retracement, but it did hold support here above 155, so we're still in a buy on dip opportunities. And now the return to 168 is a tactically significant profit target, and we'll play it accordingly. Now, price is just re-entering the river here on the downside, so that there is a 2-to-1 available just on a retest of the 10-day high. You see gold has just fallen off the chart here, which is why I'm interested in it. Treasuries have cracked, and so I think those are both signals of money looking to go to equities, in my view, because the alternate classes are just not there. Small caps, speculative growth opportunity has had less of a relative pullback than the broader market, so I think that looks attractive as well for risk on. And that's the remainder of the daily chart. So tactically, the market's in a good buy on dip opportunity here. Frame your reward to risk ratio. I still think because of this bruising we've had psychologically, losing 8% from the swing high, you got to play it. A bird in the hand is worth two in the bush, and cash them when you get them. So it's Ken Long from Tortoise Capital. We'll see you in the chat room.